Good afternoon, and welcome to our 2025 Market Outlook. My name is Thomas Seneca, Managing Partner of TM Wealth Management, and joining us today as well is Matt Hartson, our Chief Investment Officer. And today we just want to kind of go through our outlook for 2025. It'll take us about 20 to 30 minutes. We'll share some slides, share some insights, but also want to make sure you have an opportunity to ask some questions. So as we're kind of going through our initial kind of points and presentation here, feel free to use the chat area of the webinar to ask any questions. And at the end of our prepared remarks, we'll go ahead and go through as many of those as we can. We want to make sure we're sensitive for time and probably spend another 10 or 15 minutes after our prepared remarks answering some questions. If we don't get to your question, please, we'll take your comment or question and we'll respond to you directly. Additionally, if you'd like any copies of what we share with you today, please as well email us and let us know. We're happy to share what we have so that you feel good about preparing for the markets and the economic outlook for 2025. So with that, Matt, maybe I'll just pose a question to you. I don't know if you're aware, but there was a presidential election this year, and we have an incoming new administration. And as we start to look at what the impacts of that might be on the markets and on the economy, share with me a couple of thoughts that you have as we look at the incoming administration and how that might impact the markets in 2025.
Sure, and good afternoon, everybody. Appreciate being on and having you listen to what we're talking about today. As we're thinking about the markets, and we move into 2025. Couple themes that we want to share with you, but at sort of a 30,000 foot level, what we have is two really strong market years in 23 and 24. Obviously, Thomas, as you just mentioned, we're thinking about new president, new administration coming in here in 2025, and it's going to lead, I think, to a lot of uncertainty and I think a lot of volatility in the markets. We've had, as you know, a great year this year where it's basically been straight line up. I don't remember what it is, if we've had one or two down months over the first 11 months of the year, but it hasn't done much. We, of course, love those years, but those aren't normal. And with the uncertainty of a new administration coming in and just how far these policies are going to go. And so a couple words we'll talk about a lot today, I think, are scale and scope. What is the magnitude? How far? When do these changes take place? I think is going to drive a lot of what we see in 2025. But from my perspective, as we're getting started here, I think the fundamentals really look strong. We had, as you mentioned, an employment number, as we were talking before the meeting today, that came out this morning, maybe a little weaker than expected. Probably cements another Fed rate cut when we get to the December 18th meeting. But unemployment continues to be very low. Inflation is down at, I think, levels most people are comfortable with. It's not quite to that Fed target yet, but I don't know that they're going to push too hard to get there. And then we've got, certainly administration coming in with a pro-growth focus that we'll talk about more as we go, that I think really does lay the framework for what should be a decent market year as we move into 2025.
Yeah, I think that's, a good point to make there, Matt, that the economy's done well over the last couple of years, and as we prepare for some change, some of that uncertainty with a new administration, we don't want to make any whole-scale significant changes until we have a little bit more clarity about what the policies might be and the actual implementation of those policies might be, and the impact that they might have from an economic standpoint, right? As we look at where the economy is, where companies are, and the stock market as a whole, it's fairly healthy in terms of the earnings growth that it's experiencing, the debt levels, inflation, as you mentioned, right? It's not at the Fed's mandate of 2% or preferred 2%, but we're lower than we were, and it looks like it's trending in the appropriate direction as well.
Yeah.
Great. Well, if you want to I know we've got some slides and some information that will kind of help reinforce what we've got. If you want to kind of share that, and we'll kind of go through the graphics that we have to be able to kind of educate people a little bit more about not only kind of what we're thinking, but also it's really important, I think, as well, to not only share kind of some insights, but some actionable items, like what can you actually be doing given kind of the outlook that we have.
Yeah, absolutely, Thomas. I think that is the key. And, as we sat down and sort of looked at what are our themes, what do we think is going to drive 2025? we kind of boil it down to these were kind of the three here. And I don't know if anybody watched the boxing match of Tyson versus Paul, but that's kind of my thought as we enter 2025 with the new administration coming in is we've got some competing priorities here. And so the key themes that we have and we want to talk about are Trump version 2, a lot of pro-growth ideas. We'll get into some of those versus some anti-growth policies that have been talked about as well. Interest rates are still going to be a big item for us in 2025. I love this term asymmetric dual mandate from Torsten Slok over at the Apollo Group. So I stole that from him and put it here as part of our themes. And then the last one is valuations. We do have elevated valuations, as we mentioned just a second ago. Markets have run pretty far over the last couple of years. At the same time, we have some strong economic growth. So does the economic growth catch up with those valuations and bring those a little bit more in line as we move through the year as well? So those are really those three key themes. Apparently that's a hard word to say. I don't know, Thomas, if you maybe want to sort of jump on this first one of Trump version 2.
Yeah, I think that, obviously we're not making a political statement here. We look at things from an economic standpoint and the impact that those have. And there are some things that the incoming administration has proposed. And the question is always going to be, what can they actually get done? But at least in what they propose, there's some things that, as you mentioned, are very pro-growth that could have a positive impact on the economy. And then there's some things that could, have a negative impact on the economy. And we've got to remember that our government system is not specifically solely focused on economics like we are, right? And so as we look at, the current administration is looking at less regulation, potentially even extending the current tax rates, which would effectively be a future tax cut, looking at having less government spending, and really a pro-growth focus. All of those things lead to a positive impact on the economy as companies have less regulations, hoops they have to jump through. That's less expense, more money that can go to growth or to employees. Tax cuts, same thing. And this overall growth focus on the kind of anti-growth or maybe less growth emphasis. Deportation is something that they've talked about, right? So taking part of the workforce out of the economy can have a negative impact on the economy as wages start to go up and increasing the expenses for the companies that employ people, which is most of them. Tariffs. Right across the board tariffs. If we start charging more money for products coming into our country, that increases the cost to consumers. And as we are a consumer-driven economy, that means less money to go to other products, which can have an impact on earnings and growth for those companies. Inflation as well, right? We think they've got a handle on it, but it's not anywhere near where the Fed says they want it to be at 2%. I think we're somewhere in the 3 to 3.5% at this stage. What are we going to be able to do to get that down? And what levers does the Fed have left to be able to get the inflation down? And then I think unemployment go hand in hand with kind of the deportation mandate or effort that the new administration might have. So I think as we look at these, right, there's some positive things from an economic standpoint. There's some things that could have an impact on those positive economic elements. But as we start to look at this, right, we've got to have an idea of what can they actually do and how much, as we've experienced kind of Trump 1.0, he says a lot of things that he doesn't actually do, both positive and negative, right? And so he says, hey, we're going to go tariffs across the board. And ultimately what we experienced in Trump 1.0, it was a little bit more targeted tariffs. And so we really that's where this uncertainty element comes in. And we want to be ready and nimble to react given how these policies might impact the economy. But we don't want to kind of take a knee-jerk reaction and respond to rhetoric or words. We really want to see how these things get implemented.
Yeah, I think just while we're on that, I think that's the really important point is you have to really dig through the noise. There's a lot of noise in any Trump presidency, and we have to get there and really focus on those fundamentals, not on the headlines. And remember, when you're watching whatever your favorite news channel is, they're there to sell advertising. And so they're going to blare those headlines across the screen, but we're going to focus on the fundamentals for your portfolios.
That's right. Well said, Matt.
If we want to sort of focus then on theme two, as we talked about here, we've got this balance between interest rates. And Thomas, I think you do a really good job of talking about the Fed in terms of what should they do versus what you think they do. Do you maybe want to comment on that a little bit?
Yeah, so I mean, as you look at what the Fed's mandate is, right, in terms of unemployment and inflation, the lever that they have available to them is interest rate, right? So they can increase rates, decrease rates. If the economy's too hot, right, they start to raise interest rates. If the economy's too cold, they start to lower interest rates to really increase the amount of liquidity, basically cash and available resources to spend in the markets. And so as we look at where the economy is, right, if we take the stock market as a barometer, right, things have gone very well over the last couple of years. And so looking at should the Fed be cooling off or heating up the economy, at this stage, it looks like they probably should be at most kind of just maybe wait and see, be data driven, leave rates where they are. I know there's a lot of pressure both politically and domestically, nationally around, hey, we'd like lower rates so people can, buy homes and not pay so much in interest for cars and credit cards and everything else. But if we look at where the economy is, it probably does not warrant cutting rates too significantly. Now, given that there's a lot of pressure to cut rates, we know the income administration and President Trump in specifically loves low rates, right? He's a real estate guy, right? And all real estate guys love low rates. So there's a lot of pressure coming to the Fed to continue to low rates and get them lower. But from an economic standpoint, that's probably not the best course of action. It's probably more, hey, let's keep rates either flat and maybe a little bit lower. But these aggressive cuts that maybe some may be expecting is not the best thing for an economy right now that seems to be hitting on all cylinders, right? Do we really need to heat up a market that is pretty healthy at this standpoint? So I know the projection is that the Fed will cut rates by 25 basis points in December. I still think there's a high likelihood of that. But probably after that, it's probably going to be, let's get a little more data driven. Maybe just let rates be a little higher for a little longer rather than an aggressive rate cutting schedule.
The other thing I'd mention there, Thomas, sort of on that right side, I put there this idea of normalization of rates. We've become conditioned really out of the great financial crisis of 08, 09 of such really low interest rates. But the rates we're seeing, today the 10-year treasury is at about 4.25. By historical standards, that's a very normal rate. We can make still attractive returns on money market rates, a little, about 4.5% there. That's normal. We're just not used to it because over the last decade we've been impacted the other way. And so I do think the Fed would like, ideally, maybe not to cut as far so that they have more room if we do see a more significant slowdown in the future, but also to return to kind of a more normal state as well.
Yeah, it's interesting. You talk to people that are looking to buy homes. The current rates around 7%, a little less. You talk to your parents, and back in the 80s they were locking in 12% rates. So 7% when it's 12 sounds great, but when it used to be 3%, just 4 years ago, 7 sounds pretty expensive. So I think you're right. Getting a little more comfortable in the 6-7% range, and doing some things there on the real estate side to try and make things a little more affordable, which, when we talked about the incoming administration, maybe lowering some of those regulations and the costs that go along with that might balance out a little bit of a higher interest rate in terms of, just the home purchasing process.
Yeah, absolutely. I did put in, I wanted to come back to the Apollo Group in terms of their piece that I'd mentioned as we were sort of opening there in terms of the Fed's dual mandate. And so if you sort of look here from the inflation perspective, if you sort of see way to the upside versus the downside on the far right, they're pretty neutral. And if we then move to looking at the second part of their dual mandate, which is that unemployment side, they're concerned there, weighted the upside of being more concerned about that. And so that's that dual mandate that is always tough for the Fed to balance back and forth as they're thinking about these interest rates, as they're charged with keeping inflation low, but also keeping unemployment low or employment high, if you want to think about it from the other perspective. And so that's that balancing act. And that has really, I think, shifted now to your point on sentiment. Economies shown a little bit of signs, at least on the employment side, of weakening a little bit. And I think the Fed's focus now has really moved to making sure we don't see any sort of uptick in the unemployment market.
Yeah, so going back to the graphic there on interest rates, as I read this, what it's communicating to us is that as of September 2024, it looks like the FOMC members think that inflation is less of a risk, meaning it's going to increase. Whereas you look back in 2020, 2019, the risk there may have been, hey, there's a potential that it goes below what our target was. Is that the right way to read that graphic?
Actually, sort of the other way. I'm sorry, I should have done a better job as we went through that. So back in 2019, they were concerned that there was going to be more inflation than we were expecting. Coming through 2020, there you see 13 of the members were saying, we're concerned that inflation is going to be bad. So when it says downside, it's not that inflation is coming down, actually that inflation is going up. And as we move to the far end here, they think, if anything, they're pretty neutral on inflation. They think it's okay, relatively flat from that perspective.
Yeah, so if we take that same kind of color coding to your unemployment graphic, right? It now looks like, hey, there's a higher concern that unemployment might get lower than what they'd like it to be.
Unemployment higher than what they'd like it to be.
Oh, got it. Yeah,
yeah.
Right. It's the inverse, right?
We're kind of doing a double negative here with these two charts, so it's a little confusing from that perspective. But
right. So concerned that inflation is probably under control, but concerns that maybe unemployment might get higher and fewer people without jobs, or more people without jobs. Yeah.
Yes. Back to the asymmetric dual mandate, which is hard to say, but you did a really nice job of summarizing that with the last version there.
So that was kind. I don't know how well I did on that, but
the other thing I thought, you mentioned that I wanted to just highlight a little bit is, if we look at that deportation issue, potentially inflationary as you're talking about, what industries are really impacted by that? And you talked about the real estate market there. And that's one of the areas where less regulation should hopefully spur some increased housing development. Can potentially have some issues, though, from an employment perspective here, because a lot of our construction workers are foreign born. And so back to your point there of what does Trump do versus what does he say, this is a point I think we need to watch pretty closely.
Yeah, as we start to see, if we start to lose workers, right, that can have an impact on some of these industries, but also the cost of things, because now they're going to have to pay more money, higher salaries, because there's less people to do those jobs.
Yeah, exactly. I don't think we need to spend much time here. I mean, I think kind of the key takeaway, if we look at tariffs, again, potentially inflationary, if we were to go to the extremes, we could have some pretty negative impacts. And there's a number of different estimators we pulled together here, kind of neutral economics people purely looking at the fundamentals. However, if they're fairly minor, you can see the tax foundation there where they put even just a 10% universal tariff, only about a 0.5% negative impact to GDP, which I don't know what you think, Thomas, but I would expect better tax policy, pro-growth policy should offset most of that.
Yeah, I would think if we're, I think, yeah, this is a busy graph, but I think what it highlights, or a busy graphic, but I think what it highlights is if there is targeted limited use of tariffs, it's not going to have as significant an impact. And there's other things going on from a policy standpoint, right? Fewer regulations, pro-growth, that will probably offset any negative changes in GDP. If he gets more broad, as we talk here, kind of universal and aggressive impacts of or use of tariffs, then I don't know that there's as much that can offset, those significant increases of goods coming into the country, where it could have a, upwards of a 1.5% negative impact on real GDP. So I know President Trump has talked about, some significant use of tariffs. And is that a negotiating tactic, or is that an implementation of policy? That's where we talked about at the beginning about some of this uncertainty about what's being said versus what actually gets done. And we've got to kind of start to cut through the noise and look at the data to see what's happening. So if we start to see aggressive use across the board of these tariffs, that's going to change our investment strategy pretty significantly.
Yeah, but I think it's safe to assume, at least from my perspective, and as you and I have talked, that we think it's more of a negotiating position based on Trump v1 than an actual policy.
That's right.
You want to take a crack at valuations, our third theme here?
Yeah. So as we look at just from a price earnings ratio historically, how, and this looks at the S&P 500, right? And the forward price earnings ratio, right? You can see there at the 30-year average, it's about, call it 17% is kind of fairly valued on a historical basis. Right now, the S&P 500 has a, valuation of about a little over 21 times earnings. And so if we look at that, right, that's a significant valuation beyond, one standard deviation of the historical average of valuation. So it basically just tells us, hey, current valuation compared to historical norms, we see this being kind of a significantly valued market right now. And the conversation that you and I were having, Matt, is okay. Well, what does that mean, right? What does that mean looking forward? Does that mean okay, we're heading for a crash? No, as you understand kind of what the price earnings multiple is, right? It's looking forward at the price of the S&P 500 and the earnings of those companies, right? And that's the ratio. So a couple of things can happen if the market, the value of the price of the S&P 500 stays constant, but earnings go up, right? That can potentially get us back into a multiple that is lower or consistent with historical average. But that then means that the market is going to be pretty flat, right? If we have some growth in earnings, then that can have an impact to bring the multiple down, but also increase in potential returns. So I think it's what the kind of the takeaway here is, that market is compared to historical norms is at a higher valuation. And so we need to be a little more selective about where we're placing resources, given what we think the outlook on earnings might be moving forward.
Yeah, I think really well said. And sort of talking about the outlook on earnings, that flows nicely into this next table we put together, and that's the tax cuts you were talking about. Trump has proposed bringing the corporate rate from 21 down to 15. That would be about a 4% benefit to the S&P 500 companies overall. And so if you apply just really simple math there, kind of apply that 20 multiple you were just talking about, just that tax cut alone should allow for about 8% appreciation in the market. So to your point on earnings being a really important component of that, I think is important to understand. And then, as we're looking and talking about this and thinking about client portfolios, this idea of who's impacted the most, you can see there at the top, consumer discretionary, communication services. Those companies are going to have a significantly larger benefit from these tax cuts if they are to transpire.
Yeah, and I think putting that in perspective, right? On a historical average, S&P 500 earnings usually grow somewhere in the 10 to 15% range on a for all 500 companies in S&P 500, right? So a 4% increase in those based on taxes gives us some insights that hey, there is some tailwinds here that the market could ride should some of these policies get implemented. So we don't necessarily see, just because the market is based on historical basis a little higher value than in the past, we're not projecting or predicting, hey, we're due for a crash to get things back into some normal historical valuations. There's some things happening that can increase earnings without the S&P changing that price earnings ratio, without the price of the S&P 500 going down.
Yeah, I think that's a really important point. Another opportunity that I think is worth thinking about is this idea of money market fund assets. And as you've seen on the far right of this chart here, substantial investments in money market funds over the last couple of years as the Fed has started raising rates. And that's where, we talked about kind of the flip side of interest rates. We don't like it from a real estate perspective. When we're looking to buy a house, we'd like those interest rates to be really low. But I think investors have seen an opportunity here. And what is it, 6 months ago, a money market fund, we could get a little over a 5% interest rate, and they're still, as I mentioned before, up around 4.5. So I think, when we were coming off of these lows you've seen, where we were talking, back in 2020, where you were getting basically zero in a money market fund, or really, if you look post Great Financial Crisis, you've kind of been down sub 1% throughout that entire decade. all of a sudden, when investors are saying, well, 1 is now up to 5 or 4.5, that looks pretty attractive. And you've seen a lot of money move into money market funds. However, if the Fed does keep cutting, we said it was 5, now it's down to 4.5. You have any feel, Thomas, about where you think investors will no longer be quite as excited about money market funds as an investment?
Yeah, I think once it gets close to, what the current, so 3.5% is roughly where inflation is right now. I think as we get kind of sub 4, I think in a money market right now, you're probably somewhere in the mid to low 4%, 4.25 to 4.5% you can still get in a money market account. When you start to look at, hey, I'm not keeping up with inflation anymore, I'm willing to take a little more risk, maybe put something in a bond portfolio, or for those longer term investors, something in an equity portfolio. I think once we start to slip below that 4% in a money market, investors can start looking at this and say, hey, look, over a long-term basis, if I can get somewhere around 6 to 8 in a bond portfolio and maybe high to low double digits in an equity portfolio, that's where they're going to start to say, I'm going to take some of this money off the sidelines and start putting it back into the markets. And that's a huge positive, right? The market is still a supply and demand. If there's more cash chasing some of these investments, right, that's going to potentially increase the price on those investments.
Yeah, absolutely. If you look at kind of that post-financial crisis average, it's down around 3 trillion. We're at 6.5 trillion today. So that's a lot of dry powder that can be put to work.
Yeah.
And this was just to sort of illustrate your point on the money market rates. Like I said, we saw the first sort of downtick here when the Fed cut rates this fall. But expect, obviously, with the December meeting, as we've talked about already, that we'll probably see those fall a little bit farther as well.
Yeah.
So Thomas, maybe a little bit, you mentioned earlier when we were talking about, we looked at the S&P 500, and everybody talks about the S&P 500 a lot because it's 500 really big US companies we all know. But there are a lot of other investment opportunities out there. Where are you seeing those opportunities for value, even in what is a relatively expensive market for those big companies?
Yeah, I think as your graphic illustrates here, right, kind of on the smaller size in terms of market cap, right? The small cap to mid caps have some opportunities to, from a valuation standpoint, to provide some returns that might be over and above what we've experienced from the broader all 500 of the S&P 500 companies. So looking, on that mid cap to small cap gives us some indications that there's some opportunities there for returns beyond what the S&P 500 might provide.
Yeah. Yeah, absolutely. And we noted, maybe some value stocks relative to growth. I know we keep client portfolios very well balanced between those two. I'd also highlight, we didn't circle dividend yield here, and people may be wondering, well, that looks cheap as well based on this chart. Why didn't we put a red circle around that? And I don't know what you think, but my take on sort of the dividend yield side is when bond yields are as attractive as they are, people don't pay as much attention and focus on those higher dividend yielding stocks because they can get the income more consistently, more safely in the bond side. And so, certainly in terms of why I didn't put a circle there, that's what I was thinking. I don't know if you have any other insights on that.
No, I think that's exactly right, Matt. Usually we're looking for income from something a little more secure, right? The dividends, usually we're using those for reinvestment purposes. Hey, let's reinvest those into the securities that are either providing those dividends or some other equity options. And so if we're looking for income, we want to provide that income as risk-free as possible. And right now with, like you said, with money market rates, in the 4s, we've got, corporates and asset backs and even some private credit. Now we're getting into the 6, 7, and 8%. That gives us the income that we need without taking kind of the volatility or market risk that, an equity portfolio might bring.
So that kind of brings us to sort of the conclusion. You started, Thomas, with saying not only do we need to figure out where is the market going, and we said there's certainly some balance there that we see right now, but what do we do as a result of that? And so you want to maybe comment a little bit on how you're thinking we should position client portfolios here into 2025?
Yeah, so I think, as we talked about kind of the 3 themes, right? One is, there's some uncertainty given the incoming administration, right? And so we don't want to make wholesale adjustments based on what is said. We want to see what actually starts to get implemented and the impacts that might have on the economy. And the second piece that we talked about is, or one of the other elements we talked about was kind of rates. Where are rates going to go, and how is the Fed going to handle the responsibility of both lower inflation, but also making sure that unemployment stays low as well. And then lastly, looking at valuation, right? That we think valuations are a little stretched. Not that we expect there to be a significant adjustment, but we just want to be aware of that as we start to look at deploying capital and rebalancing portfolios. And one of the key areas that we focus on is continuing to look for alternative investments, things that other than traditional stocks and bonds. And the reason we do that, one, is because we think private markets follow public markets, right? The public markets have a pretty good 2-year run. That means that there's going to be more money looking at private market investments. And so looking at private credit, private equity, those types of investments that can give us some different types of returns, but also manage the risk. And so things like private credit, we've got a data center opportunity that we've been looking at as well for longer term capital appreciation. Then I also think as we think about rates, right, and the potential for inflation, right, we want to look at focusing on real assets, right? So holding real estate in some that provides that inflation protection, may provide some income. And then also infrastructure, right? I think one of the things that is a bipartisan issue in Washington is, hey, we've got an infrastructure across the nation that needs some updating, that needs some attention, needs a little bit of love, and so there could be some additional investments there. And then, looking at our fixed income exposure, where should we allocate that to get the best risk-adjusted benefit in there? And so looking at, when we talk about neutral duration, we don't want to go too far out on the yield curve. We want to stay a little bit shorter on duration, meaning how long until maturity for these specific bonds. And then we want to maybe take a tactical approach to the bond allocation and look at asset-backed securities, things like mortgages and other types of investments that have an asset back to them that can provide us a higher benefit in terms of the income. And then lastly, in equities, the Magnificent Seven has had a phenomenal 2-year run. Can it be 3 potentially? We didn't think it would have potentially 2, but we can see from a valuation standpoint, there's heightened opportunities both in small cap and mid cap. And so reallocating a portion of the equity component of your portfolio into some of these areas that have some better valuation and greater upside than maybe the Magnificent Seven or the other larger cap growth type of positions. So just got a bit of a summary, Matt. Anything else to add to kind of those action items that we should be taking?
I don't think I have necessarily a lot to add. I think I want to echo your sentiment that we're not talking about a wholesale change to portfolios. We're talking about adjustments on the edges, carefully monitoring what's happening with the Trump policies, Republican Congress, those pieces, to make sure we're being reactive, not proactive, but also not going too far. The other thing I'll mention, for clients is 2 great years means there probably will be some gains coming out of some of these rebalancing. And I know nobody likes taxes. We all like to avoid those, and we do as much as we can from a rebalancing perspective in your tax deferred accounts, whether that's your traditionally your Roth IRAs, any 401k work that we can do there as well. But just do be prepared for some of the discussions. I think as you move through 25, we may be talking about recognizing a few gains anyway.
Yeah, I think the good news there is we have still a 15% for most folks, a long-term capital gains rate, which is still pretty attractive tax rate. So realizing some of those gains, taking advantage of the current tax and redeploying those in getting a rebalanced portfolio is a good strategy. So I think, kind of just to summarize, Matt, I think our overall outlook for the markets is positive. We think there's a lot of tailwind still to the markets, but we're vigilant about kind of how this new administration might impact the economy and being ready to act should some things change for us. And we know exactly where to act, right? We're looking at the bond portfolio, looking at alternatives and kind of repositioning to small and mid caps are some of the actions that we'll take as we start to get a little more clarity as kind of how this new administration and the Fed might impact the overall economy and the markets specifically.
Yeah, absolutely.
Great. Well, great discussion, Matt. Let me take a pause for a minute and see if there's any questions that we want to kind of address Christina, if you've got any questions, we can kind of start to address some of those questions if we've got any. If not, then we'll go ahead and pause. Okay, great. Well, hey, if there were any questions that were asked that we didn't get to, or you have some that come up later, feel free to email us. We're happy to address those on a one-on-one basis. And appreciate you joining us this afternoon. Hopefully that's been helpful. Again, if you'd like to get a copy of anything that we've shared or talk about them in greater detail, feel free to reach out to us. You can find our information at tmwealth.com. And thanks for your time today.
Thanks, everybody.